Natural gas production in the US is booming. It reached its highest level in history at 100 billion cubic feet per day in November 2022. Yet natural gas prices have remained mired in historically low prices below $3. So why does production continue to grow? And can current production levels sustain given such low prices? The break-even cost of production is the average natural gas price at which a producer would need to sell its production to neither lose money nor make a profit. According to recent data from Bloomberg New Energy Finance, break-even economics vary widely by production basin. It seems paradoxical that producers might break even with negative prices, but in some markets they can because they produce oil and natural gas liquids, along with the natural gas. With certain types of wells, producers don't have the option of producing just the most valuable commodities, but must produce all fuels at once. In some basins such as the Permian and Eagle Ford in Texas, natural gas is produced as a byproduct of oil. Even in basins such as the Marcellus Basin, which is primarily focused on natural gas, the economics vary significantly based on the presence of NGLs. This is demonstrated by the Marcellus wells with natural gas liquids break-even price of $1.77 compared to a price of $2.43 for a dry well. This means that a producer of a wet gas can do quite nicely with a market price of $2.25, while a producer with a dry well will lose money. The value associated with producing a well varies depending on the ratio of oil, gas, and NGLs, as well as the market price of each commodity. Prices vary significantly over time, requiring producers to continually evaluate whether to keep drilling more wells. Also, banks must continually evaluate whether to keep lending producers the money to drill wells. Given this background, we circle back to the question of whether or not robust gas production is sustainable. It partly depends on oil and NGL prices. If those fall significantly, gas production will decline. But perhaps more importantly, wet and associated plays may not offer sufficient production to satisfy the expanding gas demand in North America. If that is the case, most dry gas wells will need prices between $2.70 and $3.20 to be profitable. Thus, producers of dry gas likely can't keep financing new drilling, which means gas prices must rise above the $3 barrier to attain enough production to meet demand.